Ladies and gentlemen, good day, and welcome to the earnings conference call hosted by Craftsman Automation Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the opening remarks are concluded. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. I now hand the conference over to Mr. Srinivasan Ravi, Chairman and Managing Director of Craftsman Automation Limited. Thank you, and over to you, Mr. Ravi.
Thank you. Good afternoon, everybody. Thanks for joining the earnings call. The presentation has been updated in the exchanges, so I hope we had time to go through that. So we are ready for the Q&A. Please, who is in the queue? I think we can start the Q&A.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use their handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Ladies and gentlemen, you may note that some of the statements which may be made by the management team during this earnings conference call may contain certain forward-looking information which are not guarantees of future performance and are subject to a number of risks and uncertainties. We encourage you to refer to the disclaimer in the investor presentation of the company. Further, the management will not be addressing any customer-specific queries owing to confidential obligations. We kindly request that you avoid mentioning any customer names in your questions. Ladies and gentlemen, we further request all participants to ask maximum of 2 questions at a time to allow the other participants to ask their questions. We take the first question from the line of Mumukesh Mandlesha from Anand Rathi Institutional Equities. Please go ahead.
Yeah, thank you, sir, for the opportunity. So on the aluminum side, aluminum standalone margin, sir, this quarter there's a dip sequentially Q and Q. I just want to understand what could be the reasons for the decline. Is it some aluminum higher cost impact? And also, sir, how do you see the aluminum standalone margins over a period of time?
For the annualized basis, I think the aluminum will be moderating at a higher level. Q3, I think there's a startup of a new plant in Shoolagiri. We have incurred operational losses in the first quarter to prove out all the parts totally. So as a consolidated, as a standalone, it had affected the standalone because it's quite also a significant plant. So we have started production now, and I think production will ramp up by Q2 to a reasonable level. I think it will be improving from Q4 onwards continuously. So I don't see any big change in the aluminum business margins going forward. Optically, yes, the commodity prices have been quite violent in the upward surge, and it is quite significant in aluminum, and it has continued to remain that way. So our margin will be on the gross margin or value addition, I would say. So optically, our margin may come down, but it will be quite intact as far as the margin is concerned. The second point will be that for the secondary aluminum, there is some volatility on the imports because of the sudden surge of the dollar or the rupee depreciation, I would say. All this has played out, but we have a pass-through with the customer. Some are immediate, some are taking a month or 2, so there isn't effect in the long term, but in the short term, yes, there has been minor corrections there. Yes. Thank you.
Got it, sir. Sorry. So on the alloy wheel side, how we are seeing the utilization level for the 5.8 million capacity? And also want to check, have the alloy wheel margins moved to a normal range of something like high single-digit margin, or still it's still ramping up in terms of margins?
So we have not even touched 50% of the installed capacity, I would say, because of the high variety of parts which are under, is all subject to BS approval also, and the model developments and also customer validation. So the second thing is because of the steep ramp up and also addition of new plant, we are not in the double digit margin yet, or even high single digit. We are lower than that. But when the plant becomes optimal, I think by Q3 we should be reaching that level. Q3 of next year, I mean.
And next year Q3 we should also be in a good 60-70% plus utilization levels for the plant, right, sir?
Yes, correct.
Got it, sir. So on the
Mukesh, I am sorry to interrupt you. Could you please join back the queue for follow-up questions?
Thank you.
Thank you. We take the next question from the line of Mukesh Saraf from Avendus Spark. Please go ahead.
Yes, sir, good evening, and thank you for the opportunity. Firstly, is on the powertrain segment. Could you kind of give us some sense on the fact that commercial vehicle segments looking better now? The outlook seems a lot more positive, and so does tractors. So how do we see this segment fare for us? We've seen numbers around this 450 crore now quarterly run rate. How can this kind of ramp up further?
In the last, mostly a couple of years, commercial vehicle was quite muted, and even tractor was muted. Now, tractor is doing very well in this financial year, and commercial vehicle is showing some green shoots of some marginal growth. The more interesting portion will come in the coming years when commercial vehicle moves to the higher engine capacities and gearbox capacities, which we expect. The norm globally of heavy duty means higher horsepower, 400 plus horsepower, plus also on 1,800 Newton meter. But we are seeing a little of seeding in the market by some of the OEMs in India, and the results have been quite positive. They're only battling with the delta cost, whether the productivity and fuel efficiency are offsetting the initial investment. So this will move just like any other product moves up for the higher capability, which is more productive for the fleet owners. This will happen. That will be the more interesting. So absolute numbers will be growing at single digit, yes. At the same time, the growth in tonnage also will be at single digit. But I think the ability to turn around the fleet and the per vehicle cost, I think that is set to move up as we move forward.
Right. So we should kind of hence see that benefit for us flowing through.
Yes, and the silver lining as far as Craftsman is concerned is this means new product development, and at least we can really do the costing from scratch at the current capex. The capex is also very high related to any infrastructure and also import of machinery because of the exchange rates. And we have the new labor code which is coming in very soon. That also we need more automation. Craftsman has been preparing very well for the last 3 years on manpower productivity by investment into automation and better equipment, or I would say more productive equipment in line with the international level of operations. So the international competitors. So that in that sense, I think new products call for also high reliability from the suppliers and high capability from the suppliers also. So that will help us to price the product right, and the end product of the OEM which goes to the market, the product is so highly priced because of the technology which is packed in and also the productive nature. It will not impact them, but I think I'm not saying there's a price reset, but I think reasonable pricing compared to the legacy prices.
Got it. And secondly, if you could give some...
Tractor sector, we are benefiting not only from the volume growth, but I think the horsepower, average horsepower is increased.
Yeah. Right. Understood, sir. And on Sunbeam, if you could kind of just take us through, I mean, where are we in that journey towards double-digit margins now that we've been running it now for a few quarters? So, do you kind of see that it's going to happen, say, in the next 2 quarters, 3 quarters? How do you see that?
3 headlines. One is the heavy weightlifting of Sunbeam is over, that we have crossed the most critical point of 50%, and now it is a journey which will continue to improve. So we will be seeing margins from Q2 of next year improving. We'll end the year for a 10% sort of EBITDA level from the current year of around 7% totally. So the exit run rate will be much higher. That is, the Q4 will be higher than the 10% is what we see. And we have not still taken any new business which we will be starting in the coming quarters. Even on the two-wheeler side, there are premium vehicles coming up. There is a shift towards outsourcing of machining activity which the OEMs are doing in-house. And we are strategically placed in many geographic locations for the business. So, for Sunbeam, especially, we are also having a plant in Gujarat, Ludhiana, and we can supply to Uttarakhand in the plant at... Yes, and also in the south, we are not invested for Sunbeam, but it's possible to look at similar parts and maybe so invest in the future. But I would say that those set of family parts Craftsman is doing as well as Sunbeam is doing for two-wheeler. Sunbeam has also got increased potential for the exports going forward. While we wait for the total restructuring of Sunbeam to happen thoroughly, we have more or less integrated the three teams on the working side of it. We have participated in the Eurogoose exhibition just 2 weeks ago in Nuremberg, where all this key aluminum exhibition for aluminum suppliers, and all three teams participated together. We have exhibited the products together. We see a good response. The traction of being at least getting to a medium-sized aluminum company in the coming 2 years as a group will help Sunbeam to leverage that.
Okay, got it. Understood. Great, sir. Thank you so much. I'll get back in the queue.
Thank you. We take the next question from the line of Abhishek Jain from AlfAccurate Advisors Private Limited. Please go ahead.
Thanks for opportunity and congrats for a strong set of numbers, sir. Sir, in industrial and engine segment, we have seen a very sharp jump in EBIT margin. So just wanted to understand, is it sustainable, and are we looking some improvement on the business and on the top line and the margin both sides, sir?
Yes, it is sustainable, and with the operating leverage which we are now started to generate, we will see margin expansion in the next financial year. And the demand for these products is increasing in India, and we are the second largest player in the country as far as the static racking, and we are one among the two largest Indian players, I would say, on the automated storage, and both are gaining traction. The second important point is, since the market is also growing and there's been consolidation of the supplier base, it is a very clear segregation which has happened from the top 5 players and the other players. They have become regional players. And also on the top 5 players, I think the number 1 and number 2, where we are number 2, and among the other 3, there is also clear gaps which is there, just like in the passenger vehicle segment. This means the larger projects execution mostly lies on 3 of the suppliers. So that way, I think there's no need to undercut each other on this matter, and we feel that we have made enough traction and also proved the product in the market. So we need not also go on a sales price cutting strategy to win orders. So the optimum utilization of the plant will come in the next 2-3 quarters, where we will be able to see margin expansion due to better operating leverage and also better purchasing power from the steel.
Okay, sir. Got it. Sir, my next question on the operating margin side, from last 2 quarters, we have seen that operating margin is hovering between around 15 to 15.3%. So just wanted to understand what would be the margin lever in quarter 4 and in FY27. As you said that this quarter margin also impacted because of that addition of the new plants, and that impacted to some extent the aluminium margin. So if we take the FY27 number, what kind of the what kind of the margin expansion we can build in our model?
The model of percentage of revenue as the margin, I think it doesn't hold good for many reasons. For example, aluminum exports from China has been dropped by 8%. So aluminum prices have jumped by around 16%, from $2,800 to around $3,250, something like this. So highest levels in April 22, which was the last peak. So when the top line only increases with the same value addition, not margin, but value addition, absolute value, artificially looks like the margin reduces. So we have to look at it in relation with the commodity prices. So I would kindly request you to look at the gross margin and the margin versus the EBITDA margins or EBIT margins versus the gross margins. That will be the right figure, because aluminum again further increases. Artificially it look like our margins have come down.
But in the third quarter, if I see that top line number of this aluminum business, that was quarter-on-quarter flat. Despite that, we have seen around 200 basis margin contraction. So if you can throw some light over there, that where the key reasons for that 200 basis of margin contraction on EBIT level, and how these numbers will start to improve?
See, the revenue, what you see on the aluminum is some of the increased aluminum prices. So you can say that the top line has been flat. It may be reduced for us as far as our contribution goes totally, because it may be attributed, the top line being flat or growing or being stable, maybe because of the increased aluminum prices. So you cannot just come and look at the top line and look at it. I said only one-time event about this new plant at Shoolagiri for the alloy wheel, which has impacted our margins. Yes, that is will be there for a quarter or two, then it will go away, just like we had in the past about when we started the Bhiwadi plant, if you remember. But otherwise, the top line are not strictly comparable between even Q2 and Q3, because aluminum prices are different.
Thank you, sir. That's all from my side.
Thank you.
Thank you. We take the next question from the line of Nikhil Rao from iThought PMS. Please go ahead.
Yeah, thanks for the opportunity. So I have a question on the order book for stationary engines. Can you provide the split for the 100 million between prime power source and backup power source?
So our customers do not tell us whether it's for prime power or backup power. So we have no, and these are fungible. At least the product what we make is fungible. They manufacture everything under one roof. So the second point is the order book. I think it is we are inching towards an annual level of around $60 million now dollars. And that also for FY29. And now the balance $30-40 million also will get tied up in the next year or so. So we will be on track with the $100 million revenue for FY29, FY30. FY29, possibly if the testing and acceleration, the demand for the products is quite high, and the customers' support on the product on the order books as well as on the product development is quite significantly high. We will be touching a peak requirement in the market by 2030. All the OEMs are geared up towards that. So we are in time for this to catch this upward curve.
Okay. And from this Stromberg acquisition, do you see any demand coming in beyond data centers, like from other industries? And also, what kind of steady-state margins are you expecting from this business?
See, energy per se has been growing not significantly in the past, but this data centers or AI has driven the energy to be suddenly spike, I would say. But even after spike is over and even at larger base, we still see energy will demands will be keep growing and backup requirements will keep growing. So, but it will not be as high as this what is happening. So once we are into this elite league of this supply of these critical parts, I think there is a lot of validation required to onboard a supplier. We are through with the first phase. Second phase is on now. So we will be starting to supply in a year and a half. The first invoicing will start. So that is the most important point in a milestone, so that we will continue to leverage this relationship with our customers for future products. India per se is also well poised for this, taking advantage of this technological growth, because there is not much of capacity in Europe nor in North America. Since Craftsman also owns a foundry for these large engines, Craftsman Fraunburg, which is in Hamburg, which is near Nuremberg. We have an insight into whatever capacities are available in Europe also, totally, and what is really happening to those capacities. So we are working hand in hand with the customer to see we align with their future requirements on volume.
Okay. And one more question. What are the current debt levels of the company, both short and long term? Given that OEMs finished 2025 with near optimal inventory days, has that been like a bullwhip effect on your working capital needs because of the recent surge in demand? Because of the GST reduction?
No, on the powertrain, I think there is no increased requirement of working capital per se. In aluminium, I think the delta price of the price increase will have that marginal 10% or 15% increase in the working capital requirement. So the question is net debt to, I would rather look at debt to EBITDA. Debt to EBITDA on a consolidated level, we are at 2.55.
Okay.
On a 9-month figure, which is annualized.
Okay, thanks. That's all from my side.
Thank you.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star and 1. We take the next question from the line of Edgeoff Frederick from Sundaram Mutual Fund. Please go ahead.
Hi, sir. Thanks for the opportunity. Sir, in aluminum, are there products where we can benefit out of this aluminum price increase, meaning it is not on per tonnage basis and on more product level pricing?
We never have ever quoted for per tonnage basis at all. Okay. Aluminum is a calculated material cost, and that is it, and that is anybody can calculate it, not only the customer. So it is a very clear engineered number which nobody can dispute on the weight of the part nor on the cost of the material. Cost of the material, of course, there can be some dispute on plus minus 3% on market prices. That is it. So beyond that, whatever is the gross value addition, what we do on the casting side and the post casting process can be painting, can be some heat treatment, and also can be also the machining side. So we are an engineered company where we do a lot of machining per se as Craftsman standalone, but Sunbeam and DRXN are more on the casting on the side. Sunbeam on the exports, yes, it is a fully finished product. So we never have ever quoted for per ton basis on the matter. It is always component to component, this component, this price.
Okay. So, despite quoting at those levels, you're saying the spread is what we compute as value add. So always when prices increase, there will be a optical reduction in margins. So that will always happen. Right?
Yes, correct. See, suppose a tailor is getting 1,000 rupees for stitching, and the garment is 2,000. The margin is on, say, it has got a 300 rupees margin. So the material cost goes up. We have it is a pass through. So it will only optically increase the top line
revenue. Yeah, got it. So, sir, secondly, on this Euro FTA, can there be better opportunities than earlier envisaged in Kothavadi from Europe?
No, I think the Kothavadi project is based on a very special product where there's a unique, once-in-a-lifetime sort of an requirement coming up for the OEMs who are manufacturing those products, which are hardly less than 10 companies all over the world. So this is driving that they are going to lose their customer base if they don't ramp up on that matter. So everybody is in a race to create capacities. Nobody is worried about this FTA per se. I think I mentioned in the previous earnings call, the engine or the generator. The generator costs anywhere between $1 million to say $1.5 million per generator, whereas our product may be around $20,000-$30,000 depending on the configuration and size of the engine, things like that. So we are not any significant game changer as far as their bill of material or their cost goes in. So it more is driven by the capability of the supplier, in this case Craftsman, and also the reliability of quality is extremely important for the customer to take a decision. This was normally made in-house. So the trust to give it the orders outside to a supplier itself is a big step for these OEMs. If you ask for the other, not the bottom of the pyramid, at least the middle of the pyramid products, where we are somewhat present a little, but on the top of the pyramid products, this is not the criteria. FTA is not the criteria. But middle of the pyramid products, there is an, earlier it was we need to be 30% cheaper than what they develop in Europe. Now the Europe costs have gone up and now they're feeling the pinch. Now they're looking at 20% we should be cheaper than Europe to get the order. We don't really engage on the sort of businesses. But with this FTA coming in, I think the gap will be further reduced totally. So the trust on India's supplier base has to improve because of infrastructure for shipping, logistics, reliability of quality and delivery. Once it improves, we can come at even at 10% leverage we have on the pricing. If we have lesser pricing than the European counterparts, we can easily win the order. But on aluminium, the other things are happening. Now I'm switching out to aluminium, sorry about that. But I would say that I want to clarify, aluminium, there is a lot of distress in the aluminium supplier community, vendor base, especially in the auto ancillary, both in North America as well as in Europe. They all invested heavily for Europe, and many of them are getting insolvent or they don't have the ability to invest further. So when the swing back is happening to hybrid and ICE in a bigger way, these companies are not able to adopt at all, and the products have to be outsourced to other regions. So we are still competing with our Asian partners and other regions also. So I think we are not really competing now with the European supplier base or the American supplier base on the products what we manufacture.
Very clear, sir. Thanks for this.
Thank you. We take the next question from the line of Mumukesh Mandlesha, Institutional Equities. Please go ahead. Mumukesh, please unmute your line and proceed with your question.
Yeah, sorry. Thanks for the opportunity again. Sir, on the capex side, what was the capex for the 9 months and what is expected for the full year, sir? And can you again indicate the debt level? What is the debt gross and net currently, sir?
I think this can be taken offline on this subject. So we'll be reading out a lot of numbers for various subsidiaries also. We have to, as I mentioned, consolidated net debt to EBITDA, you know the EBITDA levels, it's 2.55 as of now. And today the return of capital employed is pre-tax is around 16% totally. ROE is around 12% annualized. So we look at it now, there is big upsurge in orders as we speak also. So we are looking at standalone capex for Craftsman around close to 1,000 crore this year, because we have added quite significant revenue. If you recall, our IPO value when the turnover was around say 1,300, 1,400 range, and now this year alone we will be adding around 1,000 crore to the top line overall. And we are seeing that this growth is going to continue in the coming quarters, also in the coming years. So we are incurring capex at that level. So I would not like to comment on closing debt or this, but I think we have seen the higher level of net to debt EBITDA at 2.55. This will keep improving.
Got it, sir. And so finally, sir, on this recently